Welcome back, everybody. My name is Michael Rivera. I'm the CEO of the Association for Corporate Growth Los Angeles. Today, we're going to be speaking about the following panel topic: aerospace and defense insights, trends, outlook, and M&A. We've got a terrific panel today of executives and deal makers from the space. A quick note, please use the Q&A function that you'll see towards the bottom of your screen for questions. We will have time for questions and answers at the end of the presentation. Ryan Boyle, one of our program day chairs, will be moderating that process. So again, as you have questions during the presentation, please put them in the chat box, or excuse me, in the Q&A function at the bottom. So with that, I'd like to welcome our moderator for today's event, Stephen Moon. Stephen is the Deputy Head of U.S. M&A and Co-Head of Global Aerospace Defense Government M&A Advisory for Duff & Phelps, based in the Los Angeles office. Steve has nearly 20 years of experience across industrials, A&D, and corporate finance mandates, assisting private equity firms, public corporations, and private company clients with M&A, sales, divestitures, recaps, leveraged buyouts, debt and equity financing, and fairness and solvency opinions. Stephen is the former president and current board member of the Association for Corporate Growth Los Angeles, and he serves on the executive committee of the SoCal Aerospace Council. So Steve, I know we've got a lot of high quality content that we want to get through today. So without further ado, I'll hand things off to you for the program. Thanks, Steve.
Great. Thanks, Michael. Thanks everyone for joining us here today for ACGLA's annual A&D panel. Normally we do this in person, normally over at the California Club, but being that we're in this pandemic, hopefully we'll all be able to get back to these events live here later this summer into the third, fourth quarter. Let me jump into the panelists. We're starting off with Kevin Mitchell, which is top left for most of you here. He is the Sector Vice President of Global Supply Chain at Northrop Grumman within Northrop Grumman's Aeronautics Systems Division. Those that don't know Northrop is one of the largest defense primes in the country, multinational aerospace A&D tech company with over 90,000 employees, annual revenue over 37 billion. The Aeronautics Systems Division provides military aircraft, autonomous systems, aerospace structures, and next-gen solutions for aircraft such as like the JSF Joint Strike Fighter F-35, the B-2 stealth bomber, and various unmanned aircraft systems. Kevin oversees a multi-billion-dollar budget responsibility for supply chain efforts that includes many suppliers as well as teammates that comprise the essential part of Northrop Grumman's team. Thank you, Kevin, for joining us. Next up is Steve Oswald. Steve Oswald is Chairman, CEO, and President of Ducommun. Ducommun is a publicly traded aerospace and defense company based in Santa Ana, California. It's actually distinguished as the oldest company in California, founded in 1849. Ducommun today is an innovative manufacturing solutions provider for the A&D sector, split into two core areas. One is the Electronic Systems Division, and the other division is the Structural Systems that produces components for aircraft platforms, military programs, as well as for space platforms. Thank you for joining us, Steve. Next, Brian Perkins. Brian Perkins is the founder and CEO of Navaria Group. Navaria, based out in Fort Worth, Texas, is a precision components manufacturer for the A&D market. The company specializes in highly engineered fasteners and C-class components. Brian helped scale Navaria over the many years through acquisitions as well as organic growth initiatives that ultimately led to the sale of the business, recap of the business with private equity group KKR back in last year, January of 2020, right before the pandemic. Great timing, Brian. Thanks for joining us. Adam Bencover. Adam is the vice president at HEICO, where he leads the company's mergers and acquisitions efforts. HEICO is one of the most prolific A&D strategics out there. They're a publicly traded company, $18 billion market cap, that provides products and services in different niche areas within aviation, defense, space, and in electronics. Thanks, Adam, for joining us. So why don't we jump into it? The way that we're going to split up this panel is to cover defense first, the defense sector, and then cover the commercial aerospace sector second, and then get into mergers and acquisitions in the sector and talk a little bit about valuations, sector activity, interest areas, and whatnot. Just way of background, the defense sector has remained defensive throughout the pandemic into, over the past several years through the pandemic and today. And this is, in the backdrop of kind of the significant downturn in the commercial aerospace sector. There are some questions about the potential cutbacks within the defense budgets with the new Biden administration, with the Democratic controlled Congress. That being said, there are a lot of great areas of growth within defense, and we'll cover defense in general, but maybe starting off with Kevin. Kevin, can you just give us your view around the defense sector, kind of maybe short, long term, and areas of brightness that you're seeing?
Great question, and thanks a lot, Steve, for the question. When you look at what's going on in the defense industry, when you look at what's happening near term, all the procurement budgets and the priorities for the procurement budgets is pretty much set for the near term. When you start to look at the long term, I think that's where the questions are starting to come in. Where's the money going to go? How's it going to be allocated? And we definitely, as we look at the far term, looking at the opportunity space, we believe there's still a bright side. When you look at the threats that are out there today, everything's going to be driven by threats. And as you know, the resurgence of Russia, and you look at the rise of China, those two are going to be a focus area. And as we as a country start to look at those focus areas, we have a very strong support, bipartisan support by any administration that's in office to really support the national security. So when we look at the technology and the solutions that we need to bring forward, I think what we got to focus on, how can you bring it to market fast? And that's going to be something that's going to be really critical. Speed to market is going to be essential because our adversaries, they are really catching up and closing the gap on us right now. And because of that, we cannot wait to bring solutions to the market too slow, because they'll catch us, and then that's going to create a significant challenge for our national security. So technology, bringing it to market fast, looking at spares is going to be something significantly they're going to look at. So when you look at the opportunity space, there will be some competition, strong competition for those programs that are performing well versus those ones who are not performing well. So we're going to look, when we look at the landscape, we do believe being competitive, looking at our portfolio, in particular Northrop Grumman, we are very well aligned with the priorities of the United States defense. And we look at all the opportunities that we have, and especially looking at the nuclear triad, we are very well positioned with our portfolio and our leadership and technology to really support those initiatives. So we're pretty hopeful, thinking it's going to be okay, but definitely it's going to be a very competitive landscape.
And Steve, Steve Oswald, to add to that?
Sure. I'd like to first, I agree a lot of the assessment from Kevin. We're pretty upbeat. I mean, I think, short term, we're going to see a couple of CRs probably this year because, it's one thing for the president or the administration to put out a top line, but then all the detail has to be done. And that's going to take months. So I think, short term, I know people don't like it, but we're probably going to see a CR or two, and then hopefully something will come together. But I agree, I read enough, and sometimes it's pretty frightening, about the threat profiles, from our adversaries. And I think, we're really, and with China being the top in my view, and I think electronics is a big deal. I think the Navy's a big deal. Obviously nuclear, what Kevin mentioned, obviously with his company is a big deal as well. So I think, you know, the Democrats can, you know, hope for all the things they want, right? They can hope for this and that, but, you know, they have to look at reality. And I think there is a lot of support on the Hill that, you know, we certainly would like a different relationship with China. You know what I mean? Because, you know, there's a tremendous amount of tension, a lot of fear. And, you know, unfortunately that's gonna rule the day. So, you know, I think more to come there. Electronics, Navy, you know, I did see a note about Russia being looked at a little differently now, you know, so, you know, maybe the Army gets pinched a bit, you know, and some other things, but I think overall it's, we're gonna have a good amount of defense spending, whether we like it or not.
Mm-hmm. And
my view. Yeah.
Thanks, Steve. And Brian, any further thoughts?
Yeah, I mean, we've been bullish on the recapitalization of certain fleets really since kind of the 2014-15 time period. So we were, you know, serendipitously glad that, you know, we were able to kind of counterbalance some of the exposures on the commercial side with things like Navy and nuclear. I totally agree, Kevin, Stephen, with that assessment. No doubt we're in a position where, you know, people will benefit if they're positioning themselves technically to support kind of that Asian Pacific theater of war or defense. Anti-missile defense, I think, is very important. So I think those are kind of the spikes that you're going to see. And I guess, you know, 2020 was really interesting. We saw, you know, defense become in vogue again. It's amazing when the investment bankers start slapping, you know, pictures of the F-35 and defense systems on all the decks that they're sending out. You know that there's a sea change of marketing. And Steve, I know you were doing that way ahead of time. But even company websites, companies are repositioning themselves as defense-centric businesses, which, you know, will that stick? I don't know. I think long-term, it's always dependent on the programs and the strategy that underpins the technology. You know, in the aggregate, I view defense spending as kind of a flat to maybe a 1% declining environment, but it's all about your spikes and it's all about, you know, where you're making your bets. And so that's kind of how I see it.
Great. And, you know, Kevin, just kind of dovetailing into kind of the military activity, the rising threats from China, from Russia, cyber attacks, the exiting of Afghanistan. How will the cadence of military activity influence the defense sector?
You know, you're spot on. First, the cadence of the activity is really allowing us to really think through our strategies and our investment strategies, both from the DoD perspective as well as from the contractors as well. You know, one thing I failed to mention the last time, we started looking at technologies that really address those threats. We're going to look a lot at autonomy, more autonomous vehicles. We're going to look at cybersecurity, a lot of work in laser, hypersonics. So we start looking at different capabilities that can help us with those threats, quantum technologies. There's a lot of efforts going on now to be very disruptive in our capabilities so that we can now get a competitive leg on our adversary, not using traditional warfare that we've used in the past. So I think there's going to be a lot in that way. And we started looking at AI. We've been playing with that for quite some time. There's a lot of more focus, really focused on AI, because the information that we need to really to get in front of some of these threats is going to be very essential to our strategy to be able to achieve those objectives.
Great. And I know we talked a little bit about the bright spots around defense or subsectors within defense. I've heard naval, electronics, C4ISR. Maybe Steve, you know, around Ducommun has a significant electronics group. You know, what are areas that you're seeing that are kind of stable growth or growing areas within the defense area?
Okay, sure, Steve. Well, first, certainly missiles. So, you know, the missile business is big business. It will continue. I was just involved with the Tomahawk Block 5 turnover. We were proud to be a part of that, and that's obviously a big deal. But, you know, most missile programs are up. Okay, they will continue to be up. there is a little, there is going to be some issues at FMS, okay? So folks need to understand that, maybe the top defense budget doesn't move, but, FMS is going to have a different lens now that we have a new State Department, okay? And, you're going to see that, impact, and it's going to be less. So, whatever that number comes out to be, we'll have to see, but, so FMS, I mean, missiles is obviously a big one, radar, upgrading radar, all the types of different communication tools on the battlefield, those types of things. I think the great point by Kevin is AI, is machine learning, AI, all these things are, going to be, a little bit more down the road, but we got to figure them out. And, either we're going to figure them out first or China is. I mean, that's the deal. So, so I think, look, we got to, and I know a lot of people on this call, which is great, people need to be really sensitized to, some of the challenges in our country, because, everybody they have children and grandchildren and everything else. And, we just can't be naive. We have to, make sure we got a lot of folks going into science, and we're encouraging young people, and we're doing the things we need to do. And it's something I obviously believe in. But getting back to your original question, really it's, our missile business is way up, but electronics as well. But, keep an eye on the FMS, okay? Because FMS is going to be a little different, okay? I don't know the exact reduction, but it's going to be a little different in the next 4 years, my view.
Great. And Brian, I know that you're more commercial aerospace focused, but I know that the mix has changed as well for you on the military side. What are some of the bright areas in your business?
Yeah, I mean, the bright areas are kind of what was already underway, which I think kind of parallels a little bit more to investments that the U.S. was making kind of in the Cold War area, actually. So, again, to kind of reiterate what Steve said, there's a reason for that. Anything that's been underinvested for, 20, 30, 40 years is going to, receive some significant attention and investment. I agree also, to kind of dovetail on the FMS, it's going to be different. I think the way that procurement is done on the defense side, and, people who are looking to, have defense as a safe harbor for growth, it's going to be different than it was in the 2003, 2004, post 9/11 environment. I think you're going to see differences in how ELA contracts on the aftermarket side. I think there's been a lot of change that have been, changes that have been embedded into kind of the service model. So the channels to the aftermarket are going to be different, and we're seeing that today. So we're having to, learn new things relative to how we contract as kind of a tier 2 supplier real time. So that's always kind of fun. I think there's also a new interesting kind of social balance to defense work that we didn't see 10 or 15 years ago with a lot of ESG requirements. There are going to be investable areas of defense where there would be substantially limited competition due to fund restrictions on a fund or a holdings ability to invest in a certain space, depending on what the end use of the products are. So I think if you, pick 2 or 3 of those interesting areas, focus deeply on them, you'll probably be pretty successful in your betting.
Great. Well, maybe on the flip side, with the Biden administration, Democratic controlled Congress here, and some of the, the talk out there of, trying to cut maybe some of the defense budgets. We'll see what happens there. But maybe Kevin, on your side, what are the areas of risk within the defense budgets?
I think, it's very early to predict. When you look at the challenges are out there, I really don't look at it from either our company's perspective. It really matters who's in office. Our products are definitely goes across the aisle. It does not matter, because it's solutions that our customer needs to address the risks that are out there for a number of our adversaries. So I don't think that's really the issue. Again, what can we invest in? What technologies can we invest in? What threats are we trying to address? Those are going to be really the give and takes that we're going to have to go do, which means you're going to make some trade because there's a lot of bills to be paid. And when the customer has to pay those bills, there's going to be things they're going to want to do, but they can't, and other things that they can't do, but they will have to do. So when you look at those challenges, I think it's good. But I think there's going to be a larger shift. We've always looked at cybersecurity in the supply chain. And I believe it's going to be even more emphasis in the supply chain looking at cybersecurity. Because when you start looking at our adversary, we know they have capability really to tap into a lot of our digital networks across our country. So ensure that we don't allow them to get inside of our supply chain and really tamper with our digital thread that goes through our systems and our manufacturing areas to really disrupt the products that we build. Is going to be very important. So there's going to probably be a bigger emphasis on how we manage our digital footprint across all different types of products in our supply chain.
Absolutely. And, I guess going into cybersecurity and, back in December with the SolarWinds hack that impacted across, the defense and government sector across the board, as well as outside of the military sector. What changes, maybe Steve Oswald, are you making to your own business for cybersecurity compliance?
Sure.
The compromise that we've been seeing.
Yeah. So there's and those who don't know, but I'm sure a lot of folks do know this, it's called the CMMC. Okay. So this is a new model which is being promoted throughout the industry. AIA, which I'm associated with, the Aerospace Industry Association, which has defense primes and other folks, as well as HEICO and other companies involved. The CMMC is really the model that is going to be rolling out in the next few years. And I think it's probably by the mid-2023 that, you need to have all these different programs, in your company. And this is going to be the cost of doing business. Okay. This is not like, oh, this is a nice thing to do, I'm going to market it. Or, this is a good thing, I'm going to tell this person that. This is basically, if you want to be in the industry, you're going to need to do this, and we should. Now, it's not cheap, okay? You know what I mean? It's especially for a company like Northrop and other big defense primes. I mean, this is, I'm sure it's tens of millions of dollars, if not more, and certainly costs to common as well. So, but I think, obviously late, right? But I think that the industry and smart people are coming together now with a roadmap, okay? And you can find this on the internet, okay? It's not like it's, something people don't know about, but this is where we're heading. And, we absolutely have to do this. I mean, from a small cap like Ducommun to, a large cap or mid-market, it doesn't matter. I mean, everybody has to make sure we have everything secure. And if you get caught and you get hacked, it could be a real problem. Obviously, a problem for your customer first and foremost. So it'll be a big problem for your business, and you just don't want to go there. So just I encourage everybody strongly to, if they don't know it, if you're in the defense game, look it up and get smart.
And again, going to Northrop, I'm sure that there's been significant changes over the ensuing months after the SolarWinds. Can you let the audience know what Northrop's doing here around cybersecurity?
Just similar to what Stephen just said, a lot of really focus on really how we not only manage our digital footprint and all of our networks, because when you look at our supply base, we really start to put a lot of emphasis there. Always have. It's a compliance requirement. Also, we go beyond the requirements to ensure that we have a very secure network. But when you start looking a little bit closer, you got to make sure you have a very good, robust training program. A lot of, new people coming into our industry, ensure they know what they can and can't do. A lot of restrictions to how do you use laptops or computers. Don't put thumb drives in. All the typical easy things to. When you have suppliers or vendors come in your facility, you don't let them bring their own laptops and hook up to your systems. So we have a lot of different controls, and we put more strict requirements on ourselves and also the people we interface with to ensure that we do everything we can to ensure that it's really tight. And we flow those requirements down to our suppliers as well. We want to make sure that they are taking the same type of cautions that we are taking to ensure that they're keeping the network safe. But when we're changing data back and forth, anything can be actually transferred from one company to the next. So there's a significant effort that we're going, not to repeat the things that Stephen said, but exactly the same type of strategies I think we're all doing to really improve the security of our networks.
Mm-hmm. Mm-hmm. Right. Maybe switching gears, and I'll maybe starting off with Brian on kind of the, well, let's say the sector supply chain. We saw the commercial aerospace sector be disrupted with no one flying here last year. But on the defense side, defense remained defensive, but there was impact in the supply chain. How have you managed through the pandemic? And how was maybe on the defense military side, what was going on with your customers on that side?
Yeah, I know we're going to get to the commercial side. So just on the defense side, I think we saw much less violent disruption, certainly than we did on the commercial side. No kidding, right? But we did still see disruption. And I think that's important to remember. Companies, correlation doesn't necessarily equal causation, right? So just because you had, Q2, Q3, some disruption in order patterns within this A&D supply chain didn't necessarily, mean that those systems weren't getting produced or that they were correlated with a downturn. What we're seeing now is kind of a modest bullwhip effect of reordering in Q1 to make up for some ordering that wasn't done in Q2 and Q3 for real cash conservation purposes. I mean, we must remember that defense primes and sub-tiers still have obligations to shareholders, and managing cash is the de facto method. Anytime there is disruption, there is there are methodologies that people deploy to conserve cash. So when looking backward into 2020, people are scratching their head asking, well, what happened to the order patterns? Well, nothing really. You just, had some period of push because people didn't know what to expect. Nobody knew in April and May if the world was coming to an end or if there was going to be, something more significant happening. So I get asked that question, quite a bit around kind of the defense backlog and what's going on. And well, defense businesses shouldn't be impacted by COVID. Well, they are, because they're businesses. And I guess that's how I would say the defense sector fared through 2020.
How about on the common side? What was your experience and where we are now?
Well, I think first, everybody in the industry, and everyone on the phone and on this call today, should feel great about their efforts. I mean, first, we can't forget where we were a year ago, okay, where people were still getting up every day. Well, we're based in Southern California, where we had shelter in place, by the governor, and someone's walking out the door and their family's saying, "Where are you going?" Mm-hmm. I thought it's shelter in place. You know what I mean? And, and then us and the whole industry putting together these safety protocols, and, it's just, it was very, very tough. So first, everybody should feel great about their work because, people still got it done despite headwinds and lots of stress. So that's the first thing I'd say. I'd say that, look, defense industry kept moving, at least in our world, okay? You know what I mean? Like, all our, major prime customers, they were working. We got notes from the DOD on certain things, says that, you guys are working, right? So, on certain programs that were they're critical to them. So we and credit to our suppliers at Ducommun, who were also open, also got us things that we needed to make sure we got those out. So I'd say, some disruption, okay, you had maybe a plant go down for a couple of days or something happened, or you had some outbreak, or, but at least from the defense, I'm not talking commercial, a whole nother story, but at least on the defense side, I think for the most part, the industry, should get very high marks because we continue to go along at a fairly good level, and especially early on, it was not easy.
Yeah, absolutely. And maybe
Steve, can I kind of comment on that too, Steve?
Yeah, please
Kevin.
Yeah, first, I think, as you said, that many people asked, they thought the military did not get impacted, and the military side, the defense side did get impacted by COVID, but probably not to the same magnitude, definitely, as the commercial side. But I give the customer a lot of credit. They were actually great partners. Human safety was number one of their most important requirements that they had, which was definitely very important. Also, they were definitely more flexible. They allowed us to accelerate payments and things necessary to help our suppliers, especially those who had commercial and DoD work inside of them. So they needed something to help them because they had a big impact to their commercial side of their business. And then we became a little bit more flexible. We went to a flexible workforce. We had many people working remotely. So we had to shift our whole model to instantly come to a model that allowed us to take employees that was not essential to have to be in the facility, that they can work from home and still accomplish their jobs that they needed to accomplish. And it gave us great dividends. We was definitely successful shifting to those requirements. And then, as Stephen said, the safety protocols that we had to put in place. I mean, it was a learning process as you went through it, because there was always some type of trip hazard that you could find throughout do you have masks, do you don't have masks, open areas, not in open areas, in the conference room, in your office. So depending on what state you're in, the requirements was completely different. So manage that at an enterprise level became an accountability, and we wanted to make sure that it was on the right side of that equation, being compliant to the laws. So it was definitely that, and also our companies like Northrop Grumman, I'm sure our other panelists as well, we also went out and helped the hospitals by giving up supplies and help build respirators and different other things for the customers and other industries to ensure that we're doing our part as a community leader. So just a lot of things, that a lot of different innovation came about, a lot of support, but it was just not one side of the equation. Customers and contractors and all coming together, and politicians. So it was just a really great effort.
Mm-hmm. Absolutely. Well, great. Well, why don't we switch gears to the commercial aerospace? Sector's gotten hit extremely hard. Both the Boeings and the Airbus tier 1, tier 2, tier 3 suppliers all being impacted significantly with the cutbacks on aircraft manufacturing, narrow body, wide bodies, etc. Last year, 2020, there was over 1 billion less passengers flying from pre-pandemic levels. 2019 versus 2020, 65% less passengers flying. 2021 year to date, so far, we're down, roughly speaking, 50%. Expected to come back down a little bit with more travel in Q3, Q4. So there is an expectation that things will start to normalize on that side. But the commercial aerospace sector has been impacted significantly. I've had clients lose 50-60% of their business in terms of revenue. Maybe starting off with Steve Oswald, what's your viewpoint? Have we reached bottom? What's your thoughts around, are we bottoming, and when do you think we're going to come out of this?
Yeah, thanks, Steve. I think as an industry, or as a flying public, I think we've absolutely reached the bottom. And I think we're on our way up. Okay, especially, I mean, it's no secret to anybody. Domestically, things have gotten a lot better. Overseas, no. Okay, but hopefully something's going to happen in Europe over the summer, and there's going to be hopefully more effective rollouts of vaccines, and other places are just in terrible shape. We know that from the news, so we wish them the best. But I definitely feel, as an industry, we're on our way up. I believe that, and I know there's a lot of Boeing suppliers and supporters on this call. Okay, Boeing still has a pretty tough hand. Okay, because let's just they had a terrible quality culture problem, which they're on their way out, thank God. But they had lots of challenges there. They've got a ton of Maxes sitting somewhere, which they have to move. Okay, the Max is still not certified in China, and on the call with Calhoun, he hopes for the second half of the year. Well, let's hope so. You know what I mean? Because that's 25% of Boeing's business, is that market. So it's so. I think that Boeing's got a bit of a tougher hand. I think Airbus less so, for reasons we all know, right? They have a much bigger backlog. They have much better breadth. They have their quality, their act together on that. But I believe just in general, look, 6 months ago, very different story. I think end of April, I think I'm feeling good. I think that things are going to continue to get better overall. I think, Gulfstream and other folks as well. I think that's all positive, Textron. But I still think that, look, Boeing's going to be fine long term, and Spirit AeroSystems as well, as far as their key supplier. But it's going to be a little bit more of a, I think next 12 months, a little more fits and starts, where I think Airbus in the second half of the year, you're going to start seeing, they came out with it recently, 43 to 45 by the end of the year on the 320. So take heart, okay? It's coming. It's just, it's a little bit of a mixed bag, my view, at this point.
Mm-hmm. And Brian, on your side, what are your thoughts around, recovery, bottoming out, when we think we're going to get back to maybe pre-pandemic levels? Any thoughts there?
Yeah, I mean, totally agree that we're expecting to see, end-use traffic, come back up, and I agree with Steve's sentiments there. As far as the supply chain is concerned, I think the bottoming really varies by two things: where you are on the airplane and your inventory exposure that is in the system. And the variables that I think matter are the value of that inventory and how much is kind of inherently kept on hand for the customer's need. So I think you're going to see, the lower inventory that's kind of carried inherently in the system, that will recover faster. The more inventory that, is commodity driven is going to be really slow to recover. And unfortunately, I think some businesses have yet to see the worst of it. And I think that that's going to be an unfortunate reality that people are going to have to manage through in 2021. Businesses were propped up by stimulus in 2020 and certain relief programs. Those were very helpful. But I do think there's going to be some challenges. And then there's kind of the inherent problem of the way back up, which, we can talk about, on this call as well. So those are my takes.
Absolutely. I know, and Heiko, Adam, on your side, I know, from a business mix perspective, pretty diversified in terms of defense and commercial, 40%, another 20% for space and other on that end, which has been a great market for you. How are you seeing the commercial aerospace side?
Yeah, so, I think we correctly called the bottom back in May, and we have, a very positive outlook. Air travel continues to increase, albeit it's increasing at an increasing rate. And so does demand for parts and repair and overhaul. Travel in the US and China has outpaced the recovery in Europe. But, just today, Lufthansa announced that they're going to restore capacity to about half of pre-pandemic levels in Q3. And they're standing by and ready for, when and if there's a summer surge, and hopefully there will be. So, we're positive.
Mm-hmm, mm-hmm. Absolutely. I know that, you don't think of Northrop and commercial aerospace being a defense prime here, but, what are some of the challenges that Northrop faced here because of the drop off on the commercial aerospace side of things? Kevin?
Although we're not a commercial company, we definitely use suppliers that share the same suppliers as Department of Defense suppliers. So when you look at the impact of the base going away, you can see that can be a definite overhead cost that's going to transition to our side of the ledger. So you have a cost impact. You have a higher turnover rate with some of the suppliers because they're downsizing to support the demand that they have within their facilities. So people are moving around, keeping the best person that they should on the production floor that they have. That creates a turnover. That creates more disruption to the product line you have, which means you got more quality issues. So when you look at all the things that's happening in commercial, it definitely had a direct correlation to create some challenges for our industry. One thing, working close with our suppliers, we were able to overcome many of those, but not just for free. It was definitely an impact, some sacrifices, and some teaming that we have to do to ensure that we can still be able to achieve our objectives. Because number one, our objective is definitely to deliver to our customers on time. So we had to do a lot of work. And even sometimes because of the capacity of some of our suppliers went down and they didn't have the capabilities to do the things they needed to, we had to go get second and third sources to go help out, to be able to help out where they couldn't help anymore. So it was definitely, it still is some challenges out there in the supply base.
Mm-hmm. And maybe Steve, on your side, what are some of the challenges you're facing with that downturn? How's the common combated that?
Yeah, sure. Well, first and foremost, look, it affects your people, right? So, that's a big deal for me. So, when you don't have the orders, you just can't have folks just standing around. You can only clean the factory so much, right? You know what I mean? You guys have people just standing around. I mean, it's not safe and it's not healthy. So, we had a furlough, eventually, we had to, reduce the labor force. We did the best we could as far as, extending the hand and trying to be as compassionate as we can, because, no one should lose their job due to a pandemic, and so we kind of got involved in that a bit as far as helping our employees. Our supply chain, held up fairly well. Okay. So, we didn't have, knock on wood here, I didn't have a crisis where we had a supplier that, one day just went out of business. Okay. So, and that's on our commercial side. A lot of our stuff, a lot of things we buy are from big companies like Arconic and other folks, and, they're not going anywhere. You know what I mean? So we were able to kind of, manage that through a bit. And, like I tell everybody, this is like, when these things happen, you got to get out ahead of it.
Mm-hmm. Mm-hmm. Absolutely.
You know what I mean? That's what you got to do. You got to use that word, that phrase, because, if you're caught from behind, it's just going to be, 3 times worse. So what we try to do the best we could, because didn't know, right? We had the MAX issue, right? In November, December, January, and then then you had obviously the terrible pandemic. So you had lots of things to react to, and you just have to do your best, but you have to try to be as early as you can, and that's what we try to do to the best of our ability.
And maybe Adam, on your side, how did you respond to the challenges you saw on that side? And just what a background, HEICO has been made up of through acquisition, organic growth initiatives, by I think 70, 80 companies,
60 subsidiaries.
So and how do you deal with 60 different subsidiaries, different types of companies? I'd love to hear how you handled the pandemic.
Yeah, candidly, during the pandemic, 60 subsidiaries played to our strength. HEICO is diverse. I don't think we saw unique challenges in commercial aerospace. They've been mentioned, but the bigger ones would be supply chain bottlenecks, and you can't underestimate labor disruptions. But in the end of the day, we're in defense, we're in space, we have 2 medical businesses, we're in telecommunications, as well as some other general industrial end markets. So that diversification proved somewhat of a successful strategy, and it helps significantly when one of your end markets faces challenges.
Mm-hmm. Absolutely. And what about Brian on your end? Anything to
add?
add?
It's interesting you mentioned that, Adam. The smaller our facilities were, the better they fared. I think it has more to do with deliberately variable cost business models with good sticky IP versus heavy fixed cost, big infrastructure. We didn't have to shutter a plant. What we did was we took an even sharper approach to kicking things like our lean transformation events into high gear. We invested 300% more than we had actually planned to in lean transformations during 2020, because it's the optimal time to reshape how your factory becomes an efficient machine. And we're seeing that on the back end of this pandemic, with minimum wages rising with an inflationary environment, that will play to our strength. And so, being very active, but also very nimble and decentralized played counterintuitively well, I think, to our business.
Mm-hmm. And maybe switching gears a little bit on the supply chain, the future of the OEM supplier relationship. Over the past decade, we've seen quite a bit of cost outs and pressure on the supply chain. Delivering products at prices that sometimes didn't make sense. With this pandemic impact, reduction in forces, how is the pandemic and this kind of downturn going to impact these types of programs or any type of kind of partnership approach with the Boeings, with the Airbuses, with the Gulfstreams of the world? Is there kind of changes in doing business that we're going to see going forward? Maybe Steve can start off with that.
Sure. I mean, right now I think there's especially from a Boeing perspective, there's some humility. Okay, you know what I mean? And at least on the commercial airplane side, Elizabeth Lund is running supply chain, and she's talked to us, and I'm sure folks know her name, and she's the new leader of supply chain, and she's talking about working more closely together, partnership. I mean, to a certain level. I mean, look, Boeing's run the business too, so they have their expectations, and so I think it's TBD, to be honest with you, Steve. I think we'll know a lot more in the next year. I think right now people are still scrambling. I think cultures are changing a bit, especially at the big OEMs. I think people are still not together. There's a lot of these big companies, people are still apart. So I think that over time it'll come together. I'm hopeful that look, we're a supplier, we've got to perform and bring value.
Mm-hmm.
I mean, okay, what I mean? So we got to do that, or else we're not in the game. So I think that I think maybe could be some hope here that maybe there's a new framework, but at the end of the day, Boeing has every right to ask suppliers to do certain things, but they also have to hold up their end of the bargain.
Mm-hmm. Mm-hmm.
Okay, and so I'm hopeful. I think that again, there's been a lot of issues and some humilities, like I mentioned, and I think Airbus and Gulfstream. Airbus is obviously different, with culturally, so they have a little different view, and Gulfstream as well. So, but I'm hopeful that we're going to see better dialogue and better partnership. At least that's what I'm hearing.
Mm-hmm. Absolutely. Brian, any thoughts around that? Do you see, support, more of a partnership approach, or what are you seeing potentially?
Yeah, I think there's going to have to be kind of a sobering approach to long-term contracting with the supply base. I agree, Steve. It's a little bit too early, and I think different OEMs work faster than others and slower than others in a lot of cases. And I think there's going to be a recognition over time that cost curves are changing within the supply chain for a variety of macro and micro reasons. And I think that you will have to start to see real partnership, and it's probably going to start with suppliers having to be honest about where their facilities sit, where these cost curves reside, what they have to do to be a sustainable, profitable business. The defense side, historically is, in a lot of areas been certified cost and pricing. So there's been an open kimono, so to speak, of transparency around cost structures for defense contracting. Whereas on the commercial side, I think that gets lost, and people are making commercial decisions based on historical norms, and those historical norms change. People can wake up and realize that all of a sudden, maybe it wasn't a great decision to be a large supplier to Walmart, so to speak, analogously.
Great, and I'm just looking at the time here. Maybe just one more question on the commercial aero before we hit M&A. Maybe Adam could just start off with opportunity areas within commercial aerospace or business jet. What are areas of opportunity, best risk reward areas that you're just going to see here, maybe in the short to longer term?
Yeah, sure. So as you said, we're made up of 60 subsidiaries. We have a very long-term view in each of them, as we consistently invest to their growth. So we're a little less concerned about quote unquote what's hot in the next 12 to 24 months. That said, retirement rates were far less than people expected. Orders have been pushed out. Airlines are clearly going to rely on older planes flying longer. So, I think in the short to medium term, the biggest area of opportunity is the aftermarket.
Absolutely. And maybe on Brian, on your end, in terms of maybe the highly engineered fastener C-class parts sector, where do you see the areas?
Yeah, I think again to Adam's point, I think your business model can't change if you're building a great business like Steve runs that's been around since 1849. So your strategy has to really remain the same. And I think, people are going to continue to look for the business model attributes that, come with embedded intellectual property and nice moats around the businesses. They're going to be, looking to leverage the services and low capital intensity of the aftermarket business models. I think the thing that is going to be very interesting, and I don't know how to dimension the risks associated with the realities, but on the way back up, there will be a tremendous amount of pressure on the working capital profiles that a lot of suppliers will face to get back to normal. And I think when people look in the mirror and realize that they're going to have to invest perhaps 3 to 4 years of free cash flow into their business to get back to zero, that is a challenge. And I don't know how to dimension that risk, but I do know that it's going to be real.
Right. Looking at the time here, why don't we go to some of the M&A questions? Starting off with maybe kind of an overview of the market. The market defense has been strong. The volumes have been increasing year over year here through the first quarter. The aerospace side got hit pretty dramatically. Deal flow was off, roughly speaking, 40% last year. And coming into to this year, so depending on what type of business, what components you're manufacturing, what solutions you're providing, the market is softer in terms of at least deal activity. Despite that, valuations still remain high. Defense M&A activity, transaction multiples are at all-time highs. And if there's any commercial aerospace activity, they're also trading at very, very peak multiples. Adam, on your side, what's your perspective around kind of where we are in terms of valuations? Are we expected to see kind of this continued strong multiple environment? Any thoughts there?
The environment has been high for a very long time. We take a very disciplined long-term approach in that valuations or multiples should really be predicated on the quality of the company, not the cycle we're in, right? Quality meaning growth, relative market share, stickiness of earnings, and the quality of the team, most importantly. As a long-term focused acquirer, we at HEICO have the ability to look through those cycles, because we don't sell our businesses and we're going to be partners with them in perpetuity. That said, in reality, market multiples are influenced by current segment cycles. So, it's very easy to say defense valuations are up and commercial are down. And to your point, Steve, frankly, multiples never really lost traction, just earnings. And for that, all these books that come out, we're starting to see COVID adjustments. In fact, I saw a term yesterday, found it somewhat funny, called EBITDAC, the C being, before COVID. So, along those lines, the environment will be interesting to watch. Commercial will be especially interesting to watch because pre-pandemic, everything was expensive. Companies with sticky high cash flow characteristics, as well as companies, in the right segment, commercial aerospace, but perhaps ones that didn't deserve as high a valuation. For example, because of customer concentration, subpar margins, or lack of history at the current earnings levels. As these commercial businesses recover, I think we'll have more transparency into the quality of these businesses. COVID aside, I think, and I'm hopeful, the same multiples will not be applied to great businesses as they are to ones that maybe aren't so great. And I don't mean distress, but there is a difference between a good and a great business. On the defense side, to Kevin's point, budgets are locked in the near term, but we have very little transparency as to frankly the 10,000 foot view and also what programs will be prioritized. If you were to ask me, I do think defense is going to flatten. If you look at every defense book for the last 3 years, it's been up and to the right, and it's been companies, operating at a level that they've never operated before, and they don't have the history there. I think that's going to flatten, and defense multiples are probably going to taper a bit. In general, multiples have risen consistently since 2010. Multiples themselves are cyclical. They can't go up and to the right forever. So they will come down. Don't know when, but they will come down. I do know it will happen slowly though. We predominantly buy from founder owner entrepreneurs, and their expectations on value change a lot slower than say the public market. So I don't think multiples are going to come down until you've seen a prolonged, bid-ask spread between the buyer and the seller that, forces them down a little bit. It's also important to note that, while multiples are high, it's not necessarily positive when buyers overpay for a business, because those buyers need to make a return. And sometimes it's a short-term return. And thus they start making decisions for the business that, short-term decisions, maybe short-term decisions to positively influence EBITDA that aren't necessarily, in the best interest for the longevity of the business. And in that case, a business can lose its culture and its legacy. So, we're very focused on, pricing great businesses and ascribing value to great businesses. And while sure we're swept up in the tides of multiples, we do try to be a lot more disciplined than that.
Absolutely. And Brian, you've been inquisitive through the pandemic as well. Have you seen evaluations? What's your perspective around these all-time highs? Are we, is it sustainable? What's your thoughts around how companies are being valued?
Yeah, we've done 3 transactions during the pandemic, bought great businesses. Timing was right for private owners. They were not banked. They were proprietary transactions that we knew and had relationships with people they had been building for years. And, we were able to take an approach to valuation and structure of the transaction that really worked well for us and the sellers. To your point on multiples, Adam, I totally agree with the approach and the statements. Better businesses, great businesses are always worth more than modestly okay businesses. And as far as like, if you want to look at the multiple on a forward, backward, or 3-year average, I haven't even done that, because there's an intrinsic value to these types of businesses. And when we look at the future free cash flow profile of the business, knowing what we're going to do with it, that's really kind of how we came to evaluation, was kind of an intrinsic exercise. And again, that's just how we do our thing. And we're a great buyer for those types of businesses and situations. And if somebody wants to spike the ball, at the 1-yard line, that's their prerogative. And may an investment bank help them do that, Steve?
Absolutely. Just my viewpoint, from the, it's hard for a commercial aerospace company to transact in this environment because they lost so much. And owner entrepreneur, privately held businesses, they already have valuation expectations up here, and their businesses are not worth that much. So the bid-ask spread is too wide to try to figure out a way forward there. So I think volume in terms of deal activity will still be impacted here for at least for the next year or so, until things are start to recover. Unless the companies like Navaria and Heiko and Ducommun or Northrop like to pay, significantly, some obscene multiples off these lower earnings. But yeah, that being said, intrinsically businesses are, some businesses are just good businesses, and it's, and it makes strategic sense. We're, going to close on a deal tomorrow that was commercial aerospace focused here, and, was able to generate, enough interest at a valuation that made sense for the owners of the business to transact it, because it's going to make a lot of strategic sense. Now, on the M&A side, in terms of appetite, all of the businesses, the Common, Navaria, Heiko, Northrop, very acquisitive business. It would be good to hear, maybe starting off with you, Adam. What's your M&A strategy? Currently, knowing, are you looking for more diversity? Love to understand what you're looking for, what type of targets, how you're looking at, deals. Are you looking for new customer base, contract, et cetera? I'd love to hear your thoughts on M&A.
So listen, we've completed 83 acquisitions, 5 since the start of the COVID pandemic. Our strategy really is more opportunistic. We want to be the best permanent home for a business that an entrepreneur or a team has spent the better part of their life building. Our model is predicated on businesses continuing to operate as standalone entities, the same way they have in the past, while receiving our strategic partnership and support, which fosters each business's unique culture and team. But the owner entrepreneurs continue to run their business. So we refer to our strategy a little more as an acquisition partnership than just a transaction or an acquisition themselves. Because again, our partners will continue to operate the business, the same way in which they operated today. Actually, along those lines, owners often keep a significant stake in the business. Therefore, you asked about, target identification. We're opportunistic more so than looking for a specific product set, unless one of our subsidiaries is going to acquire, which frankly is a force multiplier for us, and we encourage it, and they do that all the time as well. We look for quality businesses though. So to us, a quality business starts with the team. It has very high barriers to entry. It's diverse. It has sticky revenues. It has high margins. Simply put, sustainable, great free cash flow conversion. I think we want to partner with great companies, and that's what we look for, and our aperture tends to widen over time.
Absolutely. And Brian, on your side, you built your business through acquisition. Love to hear your thoughts around what you're looking for.
Yeah, I mean, I'll echo everything Adam just said. We are not as big as Heiko, so we take an approach to looking for things a little bit more narrow on strategy. But again, as time goes by, that's widening a little bit with some of the technologies that we're, uniquely interested in. We will do creative structures and work with owners that they desire 100% exit. We'll work towards that. Again, that's easier to do if it's on strategy, because our ability to flex is, there with our business. But yeah, I mean, sticky products, good free cash flows, great history and longevity, great appropriate diversification, but we're probably a little bit more okay with the right type of concentration in a business, just because we, believe that, we acquire focus factories, and with that comes some concentration, and concentration to us is kind of like, it must be really important to those customers. So if, a supplier to Kevin, it's 50% of their revenues, we respect that, and we obviously say they must be doing a great job for that OEM. So yeah, that's it's kind of long and short of it for us.
Maybe over to Kevin on your side, in your division, your or across the board at Northrop. Any thoughts around M&A at Northrop?
Yeah, just as you know, Northrop Grumman had done a number of M&A over the years, the decades. it really boils down to pretty much what Brian was saying as well, is that what is the game-changing technologies out there that can make us more competitive? We're definitely focused on that type of M&A activity. And then, of course, risk reduction as well. We look at those are two primary ones we're looking at going forward today.
Mm-hmm. Well, great. I know we've gone over here, and I did want to take at least a question or two on that end. Ryan Boyle, do you want to take over here?
Yeah, absolutely. We've had a couple of good questions that have come in on the chat. We'll start with M&A activity since it's a good segue. First question, please comment on M&A activity in 2021 to 2022 versus pre-COVID and 737 MAX, both the amount of activity, 2020 being down 40%, and also the price multiple factors, which are still high. Will the future build rates impact multiples?
I could jump in.
Anyone want to jump in for that?
Maybe that may Adam. I think that's a good one to start off on.
Listen, I'll address M&A activity. Acquisitions come from a lot of places, and Steve, I apologize. I know you don't want to hear this, but I know Brian agrees with me. There are investment bankers, and then there's going to a company and saying, "Let's be partners," right? And if you build a consistent pipeline, and it's not really a pipeline, frankly, it's a broad base of relationships, and you keep those relationships over time. When it's time for that owner to sell, and I will tell you, I found you can't convince an owner to sell prior to when they really want to, short of walking in with a tremendous bag of money. But you can convince them to sell the HICA. So, in terms of activity, while book volume may be down, I'm not sure M&A activity is down. And frankly, I'm not sure book volume is actually down either. It seems like we're getting, about a teaser a day here. So, the focus has shifted. More defense deals came out, and then, with the 737 MAX, comment, all of a sudden Airbus suppliers came out, and aftermarket businesses came out. But I think M&A volume, at least from the HICO vantage point, has grown consistently over the last 5 years. It was challenging last year, but it hasn't tapered. It hasn't slowed down, and I don't see any reason why it would.
Mm-hmm. Absolutely. Brian?
Yeah, my only comment, I guess, to the back end of that question is, will build rates affect valuations? And I would just say, to the extent that build rates affect future free cash flows of the business, they have to. And that gets back to Adam's earlier point about the bid-ask spread. Nobody likes it. I don't like lower build rates. Adam doesn't like them. Steve doesn't like them. Kevin's in a non-commercial build rate environment. But we do have to face the reality of math. And if people can sharpen their swords around negotiating and leveraging their positions as a key supplier to an OEM, then their free cash flow position will be less impaired, particularly if they can couple that with operational efficiencies in their business.
Mm-hmm. And just from an M&A volume standpoint, just looking at all the mandates we're working on in the aerospace defense government sector, all of them are defense related. Just one has majority commercial on that, and it's what we would call a one-off situation on that front. I think most folks are not really looking to take up their companies out to market unless they have to there's a liquidity need. 3, I get a lot of calls on capital raise type of situations, needing to put money into the business, growth capital, or just recapitalizing the businesses. So I think commercial aerospace will be down again this year from what we're seeing in terms of our own pipeline. But I do think that activity will change over the course of the next 12 to 24 months.
Good. The next two questions that came in from the group are both defense related. The first one is, it seems like the U.S. has big, super expensive platforms. I think carrier groups, submarines, aircraft. is it fair to say that the future of defense technologies will be lower CapEx, maybe smaller, if you will?
Kevin, do you want to
Kevin, you want to take that first? Kevin, you want to take that, and I'll come over that one.
You know, it's a great question. The things that we build are, you know, in this industry, in this space, is hard, and it's technology that's necessary for a certain mission. And I don't see just, you know, going over to just small, just as a relationship to a mission or requirement that the customer have. But I do believe we have to be more agile. We have to have products that's going to be able to support coming to the market faster, which may create different types of scales of products that we have in the past. Now what would that look like going forward? I think there's a lot of discussion. You've seen some commercial businesses getting into the DoD recently, and they're changing the way we look and manufacture different types of products. So we want to make sure we're leveraging those commercial products and those capabilities into the defense capabilities. But we do have a distinct way of requirements that we get from our customer and certain things that they have to be able to do. And I don't want to say it on this phone call, but certain capabilities that our products have to have that a lot of those other non-capital intensive products may not be able to meet those needs and requirements. But I believe there's some aspects of some of the things we build will go down that path, but not, you'll never have a ship or a submarine going down the path that's just smaller when you have a mission that you need an aircraft carrier. It is what it is, unless you change the airplane and the aircraft carrier to be able to accommodate that type of requirement.
Mm-hmm.
Yeah, just to mention, look, you know, I think, Kevin, you mentioned it very early about, and this is for suppliers and developers, I mean, a big deal is speed. Okay, so, you know, our defense customers, they don't want to wait 5 years for something new. Okay, you know, I mean, even though something might take that long, that's why Kratos, those folks know Kratos have been very successful, because, you know, Kevin and his team have done some great work there moving that forward. And so I think there is going to be that shift, but, you know, you have to keep in mind too, we're gonna make what we should make, you know, for the most part, but there's a lot of politics involved. Okay, you know, let's not be naive. I mean, everybody, you know, you have a submarine factory in your district, you have, you know, KC-46 in your district, you have, you know, this, that, and the other, you have bases, you know. I mean, I hate to say it, but, you know, we're on this call to be candid and honest, that there's always going to be some headwind there too. Now, we're going to make the things we want, but there's also going to be other implications of just how we process things as a country. So I think it's going to be both, but to Kevin's point, we're going to have lots of big products for a very long time.
Good. The next question on the defense side is, what are your thoughts on the balance between modernizing legacy systems versus new future programs?
You know, it's going to always be a balance. And I think Brian has a lot of his business in the aftermarket. I mean, sustainment is a great business market. We love that market as well. But you'll never be able to just retool a fleet and just not sustain the fleet at the same time, a new fleet, legacy fleet. So I think that when you look at some of the products, and I won't go into the details naming product lines, that question comes up a lot. When you look at the cost of sustaining the fleet, or modernizing the fleet, sometimes some customers may want a new shiny object, but defers to something that they can go with, that we can modernize. And I believe it's a half and half, but you got to realize that as you modernize new capability, it's a lot different than when you build new. When you build new, you got the latest capabilities and technology all through the whole airframe, the technology of the materials that you're using, the weight, the efficiencies of the materials that you use, and the engines. So it's a trade-off that you're gonna take and you're gonna have. But never, I think, in the history of our country, you'll ever see where you don't have a combination of both of them at the same time.
Mm-hmm.
Okay. We have two more questions. The first, and both are basically commercial related. So the first one is, please comment on the commercial supply chain fragility. Major aerostructure supplier tech just declared Chapter 11. Is this the first domino?
Well, I'll just take a run at it. Look, I did see that, and you know, I was sorry to hear about that bankruptcy, and I know there's other I don't know specifics about certain parts of the supply chain. You know, aerostructures always has a lot of pressure, as you know, folks that have been in the business for a long time know. I mean, it's just, you know, especially if you're making big products, because you got a lot of capital and you got a lot of things that are you're up against it. And you know, I can just tell you my view is that there is fragility. You know, this Paycheck Protection Program last year, you know, certainly we didn't use it at Ducommun, but we know folks in our area, you know, structural companies, Aerospace, that they used it. And they used it twice. And okay, so it's a government program and good for them. And you know, they kept people employed and kept things going. So, but those, you know, that's going away, right? So I think there is still fragility. You know, to the degree, I'm not really sure, but I think there's still fragility this year for sure.
Yeah, I agree with that. I think distress takes a number of different forms too. I think bankruptcy is just merely one such tool, and I think every bankruptcy situation is unique. You know, as to how the business got there, why did they file? And again, this is speaking from experience. You know, I've acquired businesses out of 363 Chapter 11 that should have never been in Chapter 11. And there have been many businesses that should have been in bankruptcy court, you know, for years and just never made it that way. And there's a lot of optionality. So I think we will see a situation where there will be more public filings, but I think there will also be a tremendous amount of private ways to manage the distress that is the aftershock of such a violent downturn in an industry. That, you know, and to be clear, bankruptcy or equity cures or some other method of getting to financial health does not outshoot a business model. And, you know, that's rule number 1, 2, and 3. And those business models have to be re-explored. You know, Steve, I agree with your statement that aerostructures are up against a really challenging business model. And it's not my job to change that, but there are people that probably should be having those discussions.
Well, I just looked at the time here, and we've run out of time. Ryan, thank you for covering all those Q&A questions from the audience. Michael Rivera, I'll turn it over to you. But before we do that, I did want to thank all of our panelists here to making the time and effort here. You know, Adam's out in the Miami area, so it's getting late, past dinner time. Kevin's in a hotel room somewhere, I don't know where. So had to find good Wi-Fi here. And Steve, Ryan, and Brian, really appreciate everyone, you know, coming together, spending the time with ACG Los Angeles. Thank you. Thank you very much.
Thank you, everyone.
Thank you. And Steve Moon, thanks to you for pulling this panel together with the help of Ryan Boyle and off camera, Michael Boyle as well from Bob Search. Without those two gentlemen, this afternoon's discussion does not happen. So thanks, Ryan, to you and to Michael for that, and Steve for moderating a great panel. And as you said, on behalf of ACG Los Angeles, thanks to Kevin, Steve, and Brian, and Adam for your time and insights this afternoon. Very quickly, our next virtual event is going to be on Wednesday, May 19th. We're going to hear from 3 large family offices, the Pritzkers, the Steens, and the Duchossois family. A case study look at their partnership to recapitalize energy distribution partners. Very interesting. Visit our ACGLA website to register and for more information. And with that, once again, I'll thank our panelists and Steve Moon, our moderator this afternoon. I wish you all a very good afternoon and evening, depending on where you are. Thanks so much. Good night.